When it comes to the art of market speculations, there are a few speculation essentials that we need to be aware of and ensure that we execute without compromise when we are trading the markets. The first one is successful traders and market speculators don't bet big. We've already spoken about this one, and it's about risking only a small portion of your portfolio every time you trade. Otherwise, sooner or later, all the money that you've worked hard for to invest behind your trading business will get wiped out and be taken from you in a short period of time. In order to make money, you need to risk money. There is a time and place for demo trading and paper trading, to build confidence in a trading system, to test out a trading system, but sooner or later you have to jump in with real money. And in order to make money, you have to risk some money. There are going to be winning trades and there are going to be losing trades. Just like taking a bet on the casino table at roulette, you have to place a bet and there's an opportunity to make some money, but there's also a risk of losing money. The beauty about trading though is that you can tip the odds in your favor, as we've already highlighted in the previous videos. If you've got a system and a strategy and something that tips the odds in your favor, where either one, you are more right than you're wrong, or if you're more wrong than you're right, but your profits are larger than your losses, you can still be profitable long-term within the markets. It's different though when it comes to the casino. In a casino, if you're playing a slot machine or a game of roulette, you have to first put your money into the slot machine before you can pull the handle to see whether it will be a winner or a loser. In trading, however, you don't have to put your money in first in order to find out whether it will be a winner or a loser, because what you can do is that you can wait to find certain criteria to be met within the markets. And whatever approach you're using, technical analysis or fundamental analysis, support, resistance, candlestick patterns, chart patterns, whatever your trading system or methodology is, you can first wait for that criteria to be met within the markets. And then once that criteria is met, then only place your trade and go in to find out whether that pattern will repeat itself again. Whereas in the casino, you have to first put your money in to then find out whether it will work out or not. And so that's once again the beauty of trading. The third point is always make more than you risk. This is where your profits have to be bigger than your losses. My personal trading strategy and methodology within the markets is only right on average about 47% of the time. That's going back almost, currently right now I've got about 400 or 500 trade samples for the current system I'm using within the markets. And that's over about 5 years of trading that I've currently been using the methodology that I have. And I know that I am right about 47% of the time. So I am more wrong than I am right, but my winners tend to be about 3 to 4 times larger than what my losing trades are. So I am net profitable in the long term. So you always need to make sure that you're either more right than you are wrong for your trading system. And if you can't get those odds tilted into your favor, you need to make sure that you always make more than you risk. The fourth point is that speculation is a roller coaster ride. And we showed you that example in the previous video where we showed you that there is no guarantee that this particular month, week, or day is going to be a winning time within the markets. Your odds of winning are randomly spread over a large sample of trades, which we spoke about the random probability theory. And this can sometimes feel like a bit of a roller coaster ride. You have a really good month, which is then maybe followed by a flat month, followed by maybe 2 negative months. Then you have 3 months of growth, and then you have another flat month and 2 negative months. And so you've got these peaks and troughs in your trading portfolio. But as long as your equity curve is growing and you're making new equity curve highs, then you will be net profitable within the markets over the long term. But it can sometimes feel like a bit of a roller coaster ride, going up and down, up and down. And this is often managed and controlled by only risking a small portion of your portfolio each time. By only losing a small portion of your portfolio when you're wrong, it's not going to mess with your head and your trading psychology, and it's not going to cause these massive peaks and troughs within your trading equity curve. And when you are right, it will start to push your equity curve higher and higher, once again making you net profitable over the long term. The other really important point is to have patience and to wait, or there will be nothing left to wait for. If you are impatient and you continuously keep on breaking your trading rules and you jump ahead of the gun, you are going to lose that edge within the markets that you have. Just like the casino example that we used, If the casino starts to let the players change the rules of the game, they will start to erase the edge that they have over the player, and the odds will be tilted into the player's favor versus the odds being tilted into the casino's favor. The same applies in your trading. If you break your trading rules, you will start to wear away at your edge that you have over the markets, and you will start to lose more money than you make, and there'll be nothing left to wait for because you'll absolutely lose your entire trading portfolio to the market. And this is where the point comes around, is that if you cannot flawlessly execute your trading rules, then why create trading rules in the first place? Just like a business that has a business plan that they go to market with, and they use that to direct their business and navigate how they're going to do business in the market and sector that they're in, they need to follow that business plan. And there's a time and place to adjust the business plan and to be a bit flexible sometimes, and to realize that maybe this isn't working too well and you need to make a few tweaks and adjustments. But that's using a bit of a history and giving the business plan a bit of time to play itself out before they make any changes. The same is in your trading business plan and your trading system. You need to follow those rules, and those rules need to guide your system, because if you carry on changing them and you carry on tweaking and adjusting them, then it's just going to cause absolute mess and mayhem within your trading account. So you've got to flawlessly execute the rules, or you might as well just throw it out the window, or just not even trade at all. The other point that we highlighted in the previous video was that drawdown is a reality for any market speculator. There is going to be this random probability of wins and losses within your trading portfolio, and you don't have control over that like a traditional business model. There are going to be times where you go through multiple losing trades in a row, and you need to just remain confident in your trading system, your strategy, and your ability to pull the trigger every single time your trading criteria is met to take a trade within the markets. And there are going to be times where your system is going to have a losing trade after losing trade after losing trade. You could have 2-3 losing weeks in a row. You could have 1-2-3 losing months in a row. You could have even a losing year, but you need to carry on pulling the trigger and remain confident. And there are sometimes moments where you can review to say, is there something fundamentally that has changed within the markets that is no longer allowing me to have an edge over the market? And that is sometimes where you've got to review a trading system and a methodology. But more often than not, by just pushing through that losing streak and that drawdown, eventually you will start to make new equity highs if you just push through it. Most people will say they're going through some drawdown and they have a losing trade, a losing trade, a losing trade. And by the 5th or 6th losing trade, they start to lose confidence in their system and they decide to not take the next trade. And what often happens is the next trade tends to be the big winning trade that starts to make you new equity curve highs for your portfolio. But because you decided to not pull the trigger on this time, you lose out on that trade. So just know that drawdown is a reality, and any market speculator is going to go through that. And also, you need to have a proven edge over the market. You can't just go into the markets blindly with no trading plan, no rules, or no system to guide your trading. You need to have a proven edge over the market, and you need to stick to that edge and the rules in order to keep your edge over the market. And also, the longer you play, the greater your chances are of winning. As I've said, my personal trading methodology, I know that I'm only right 47% of the times. So when I go into a trade, my default thinking is that this trade is probably going to be wrong. And by taking that approach to the market, when I have a losing trade, I'm not surprised or I'm not saddened, because that was my expectation. I have an expectation that something is going to happen. I don't know what's going to happen, but something is going to happen, and that I know that I have an edge over the market, and eventually I'm going to have a winning trade, and eventually I'm going to have a big winner, but there are going to be strings of drawdowns, and the longer that I play and the longer that I push through, eventually my chances of winning are going to come through. I just need to keep on pulling the trigger every single time.